Hello, Mr. Bhavik Mehta. I am Abdullah and I have Ala with me, and I want to ask you, please, what are you expecting today? 3.3 or what? Do you have different expectations?
First of all, thank you, Allah and Abdullah, for having me on the show. As Mohammed was rightly pointing about, what we are seeing is different ranges from different economists and different bankers. In my view, what's going to be the most important thing to note is the today's rate of increase in the core inflation numbers. So markets are probably being too optimistic in expecting the complete inflation, that is including food and energy, to come down to 3.3%. But our best guess is that what really happens with the core inflation prices, that is going to dictate the immediately the market momentum and the technical picture as far as it's concerned.
Right, right. Ala is asking now. Core CPI is, of course, the most important. Allow me to ask you about the GCC countries. We always speak about different economic cycles and the currencies and how they need to follow the Federal Reserve policy. So the interest rate is higher for longer. How will that impact the GCC markets, and the end of the tightening cycle is about to come? How will that reflect also on the GCC on the short term?
So far, what we have seen in major economies like Saudi Arabia and even UAE, oil prices staying higher above 60 $70 a barrel. That has basically provided a good buffer, good support to major GCC economies. So I would say most of these economies are still in a sweet spot. They are able to announce big price control measures such as freezing the inflation, the higher prices of essential goods like dairy, milk products, and all. And even a country like Saudi Arabia is giving good subsidies on the energy products. Remember, this is all good when oil prices are higher. Now, most of these economies are trying to diversify away from you know the complete oil mix picture. So as we see these economies coming out of the energy product mix, there could be huge inflationary pressures if the interest rates in the US do not subside. Now, because these currencies are pegged to dollar, whether you talk about Saudi Riyal or the UAE dirham, they have to closely follow and mimic what the US central bank is doing. So, oil being higher is a sweet spot as far as things are going now.
Abdullah is asking you now about the impact on the GCC. Do you think they will be affected by the CPI numbers faster than the CPI of the GCC, which the average is 2 to 2.5?
Look at the if you look at the different CPI numbers from countries like UAE, Saudi Arabia, Qatar, Bahrain. So I would say Saudi Arabia is having one of the lowest inflation numbers. I think at 1.7, 1.8%. It has been more successful as compared to other GCC countries in taming the inflation thing. But the important point is we still have two US central bank meetings, that is the FOMC meetings before the end of the year. So it actually depends if the Fed is going to hike or not. If the Fed hikes again by 25 basis point, we are going to see a increase rate increase from UAE and the Saudi Central Bank.
Allah is asking you now. Remember, you can address her in her name in your answer. She is asking about the higher for longer interest rates. Will that impact lagging? Will there be a lagging impact in the fourth quarter?
So if you look at the overall price trends, Allah, what has happened is most of these GCC central banks, they immediately hike the rates when the Fed announces the decision. But again, the impact of the actual interest rate hikes, it comes typically with a lag of 2 to 3 months or even a quarter. So the trend that is being seen in US is similarly going to be witnessed in GCC countries also. The globally, if you see, the mortgage rates have increased, the US 30-year rates have increased. So we are seeing similar trends in EBOR and the Saudi core lending rates. So there is always going to be a scenario where the actual price picture starts increasing in a 2 to 3 month period time.
Mr. Mehta, kindly slow down a bit. Abdullah is asking about the cyber and the additional hike by 25 basis points above 5% for the interest rates. So the challenge here is an economic one for the economies that rely on the dollar in evaluating their currencies. Saudi Arabia has inflation by 1.7, as you mentioned, and the interest rates are above 5.5. So how will the balance be here? How can the economy function with high interest rates and inflation stable?
Very good question, Abdullah. So what we are seeing over here is, so if you look at the real positive rates, US has one of the highest rates. Now, surprisingly, Saudi Arabia is expected to, actually show a recession this year. So it's the GDP expectations are around minus 0.3 to 0.5% for the entire 2023 year. So what we are really witnessing is the past impact of high inflation. The Russia-Ukraine war absolutely like disrupted the entire commodity prices. Again, like we mentioned before, the sweet spot has been the higher oil revenue realization for Saudi Arabia. But going ahead, should the interest rates not come down, US and GCC countries, we might look at a scenario where major GCC economies might witness a slower growth as well for 2024 also.
Thank you very much, Mr. Mehta, for
Thank
being
you.
with us.